Hello, all viewers. Hope all of you are doing very good. Welcome to our program, Corporate Tax Series with SRS. The first episode of this series is about concept of UAE Corporate Tax. So let us start with first episode of Corporate Tax Series with SRS. Here in this episode 1, we will see the concept of corporate tax with the broadly three parts divided into background, background of the corporate tax, objectives, why corporate tax is announced by the government, and overview and basic understanding about the corporate tax. Here I will touch upon very broadly about the provisions of the corporate tax. So let us first start background. As you all know that UAE corporate tax was announced for the very first time on 31st January 2022 by UAE government. They have announced that this corporate tax will be applicable from for the financial year starting on or after 1st of the June 2023. Corporate tax to be paid at 9% on taxable income that exceeds AED 375,000 for the year. So this means that up to 375,000 of the profit for the year, there would be no any tax to be paid. Later on, public consultation document has been published on 28th April 2022 by the government. And then finally, corporate tax law has been released on 9th of December 2022. Now, objective. Why this corporate tax law has been announced? So the main objective of it is that UAE's commitment to meeting international standards for tax transparency. So government has their own commitment, and for that purpose they have announced this corporate tax. Also, the objective is there for preventing harmful tax practices, strengthening country's position as a leading global hub for business and investment, and also accelerating UAE's development and transformation to achieve the strategic objectives. So these all are the reasons why we have this corporate tax in our country. Moving forward, overview and basic understanding of the corporate tax. Now, the foremost I would like to tell you the difference between the corporate tax and VAT, because many people have asked us, and also many people have confusion. Okay, then VAT is there, then what is the corporate tax? So let me clarify conceptually, first of all, that corporate tax is a direct tax, whereas VAT is an indirect tax. Corporate tax to be payable on the profit of the business. At the end of the year, what you will have profit, on that corporate tax would be levied. Whereas VAT, being the indirect tax, is to be collected from customers while you are making sales to them. So this is the very basic difference, that corporate tax is a direct tax in the nature, whereas VAT is an indirect tax. Now, applicable to all business and commercial activities. What does that mean? It means that corporate tax would be applicable to all business and commercial activities to be undertaken across the UAE. So it would be understood like that there is no any category of the person. This person would be, coming within the scope of the corporate tax, or that person will not come. No, the basic fundamental is about activities. If you are doing basic activities or commercial activities, then you would be covered with the ambit of the corporate tax. Now the question would arise that if there is any business activity or commercial activity undertaken, and that without the trade license, then what? Whether a corporate tax would be applicable in such a case? The answer is yes. Because to have a trade license, or there is no any trade license, but because you are doing the business activity or commercial activity in the UAE, corporate tax would be applicable. So trade license has no any criteria for covering the scope of the corporate tax. Now, what is the corporate tax registration? So as you all know that when the VAT came, at that time registration was made by all of us, and TRN number has been issued by the FTA. So now corporate tax registration is also having the same, more or less same procedure. FTA is only the governing body, administrative body, and they will issue the corporate tax number. So it is not like that because you have the TRN number, you are not required to register for the corporate tax. You have to have registered for the corporate tax, although Imara platform is same for both corporate tax and VAT. Now corporate tax group versus VAT group. All provisions were there in the VAT when it was released. You can make group for your common entities or your for common companies, and you can file the VAT return for all of those companies in a single process. So there was a provision. Now corporate tax law also provides such type of the provisions, but the criteria for forming the group are much different, and we will see later on in the subsequent videos also what the criteria are there for the corporate tax group. But one thing I would like to tell you, that the criteria what provided in the corporate tax law to form the corporate tax group would be complied by minimum stakeholders of the UAE, because the criteria are like that. Each and everyone, like under VAT, all have get the chances to form the VAT group. Will not be such case in corporate tax. Now applicability. So as I told you in the previous slide, applicable to all business and commercial activity. So mainland or free zone, there is no any difference. I mean, there is no any segregation for the application. So corporate tax would be applicable across the UAE, whether you are in mainland or you are in free zone. There is a new concept, qualifying free zone person under the corporate tax. Before I touch upon that concept, we already know about the designated free zone under the VAT, right? So if you are doing the business in designated free zone, then authority has allowed exemption not to comply for the VAT. It is not like that in the corporate tax. What is the free zone, and specifically what is the qualifying free zone person? So authority has come up with some criteria and some definition for the free zone entities. If you are in the free zone and if you are matching those criteria and conditions, then you would be considered as qualifying free zone person. And qualifying free zone person means your income would be exempted from the corporate tax. Yes, you not required to pay corporate tax if you are a qualifying free zone person. I will also later on make a video for these free zone entities in a detail. Moving to next point, transfer pricing rules and arm's length principle. So this is a very new concept for UAE, although it's a very common concept for international practice. What is the transfer pricing and what is the arm's length principle? Let me tell you, this is a very depth concept, but I would like to brief it in this manner. For example, if you are doing any sales or purchase with your related company, I mean, for example, you have a one entity having the ownership with you, and one more entity is there, and that is the ownership with your family members, your father or brother or any blood relative person. So whenever you are doing any such business, I mean sales or purchase or anything, then you have to make ensure that all the prices what you are charging in the sales or what you are paying for the purchase should be at par with the market price. The meaning is that because they are the relative, you cannot make the transaction at a lower value than the market price or the at higher value than the market price. You have to have put your all the transactions at market value only. So that's the main concept of transfer pricing and arm's length principle. Next point is about small business relief. So government has come up to support, small and business, small medium enterprises, as well as a lot of startups are, coming in the UAE. So what the concept behind is that, okay, there would be some relief for the small businesses. Government would come with some, threshold revenue uh, by which if your revenue is below than that threshold limit, then you would be eligible as small business. And some reliefs have been provided to those businesses, like some simplification in compliances. Also, one more relief is there. You are not required to maintain, documentation for the transfer pricing, and that's a very big relief, I will say. So those concepts are also covered by the government. Next, income. So there will be taxable income. There would be also exempt income. Now, what is taxable income? What is exempt income? So if you say what is taxable income, so whatever activity you are doing as a business and whatever you are earning as an income would be taxable income. But government has come up with some clause of exempt income also. Like if you are earning let's say dividend, then it would be not taxable. Or you can say sell you are making any profit on sale of shares, then it would be exempt income. Also, one more example I can give you, like interest on bank deposit also would be exempt income. So government has cleared very much in a clear way that these some of those incomes would be exempted from the corporate tax. Next is expenses. So again, here it could be deductible expenditure versus non-deductible expenditure. Now, what is deductible expenditure? So when you are making the business, so there would be sales income. Also at the same time, there would be purchases and expenses. And then net profit would be as a result of your activity at the end of the year would come. So now which expenditure would be eligible? So government is telling us the expenditure which are incurring for business would be allowed as a deductible expenditure, provided you should have justification in terms of documentation of those expenditure. Whereas non-deductible expenditure Let's say personal expenses. Personal expenditure would not be allowed as a business expenditure. Also, some other criteria are provided for some expenditure like entertainment expenditure, like interest expenditure, that I will cover in the subsequent videos in a detail. But we have to keep in mind that which expenditure are deductible and which expenditure are not deductible, and if deductible, then up to what limit as provided by the law. Next, corporate tax to be calculated on taxable income. So as I said you, in your business, there would be sales, income, also there would be purchase and expenditure, and the net result would be profit. So that profit is as per your financial statements, right? So from those profit derived in your business, we have to calculate the taxable income. So there is the mechanism provided by the government, okay, how to derive taxable income from the profit of your financial statement, and on that taxable income corporate tax would be applied. Now the question will come, what about business loss? If loss is there, then there is no any question of the tax, right? But this loss, government has made it very clear that you can carry forward your loss for indefinite period of time. So in future, if you have any business profit, or you can say taxable income, then this loss would be setting off against that income. Yes, the mechanism is provided by the government, that how much loss to be set off and in which manner. But at least there is a great relief that government has provided indefinite period of time for setting off this loss. Next one is taxable income will be derived from profit or loss as per financial statement. So as I told you in the previous point, that there would be profit or loss as per your financial statement, but that is not the you know figure on which corporate tax has to be paid. From that profit or loss, we have to calculate taxable income as per corporate tax law, and that mechanism has been provided by the government, okay, how to compute the taxable income, and that would be derived from your profit or loss as per your financial statement. Now, at the end of the year, government has asked us all to file the corporate tax return. So there is a one return for 1 year, unlike VAT, right? And whatever the taxable income is there as per the corporate tax law provisions, you have to compute the corporate tax, and you have to make the payment in a prescribed manner. This is one of the most important point, I would say, concept of self-assessment. What does it mean? It means that government is asking us, you have to compute all this, corporate, you have to compute all this taxable income and you have to pay the corporate tax. But the thing is that it is as per your self-assessment. You have to decide whether you are doing it in which manner. So it is self-assessment. Government is not going to check at the time of the filing of the return or at the time of the payment of the tax whether this is correct or not. Government has put the onus on you. Okay, you have to do it correctly and as per the prescribed manner. So this is what the government is expecting from all of us. Maintain accounting records for 7 years. For the VAT, we all know books of accounts has to be maintained for 5 years, and later on recently they come up with the amendment in the provision, and now the books of accounts has to be maintained for 5 plus 4 more 4 years if you are getting the notice from the FTA, right? So here they have told us to keep the records for 7 years, and again later on they may increase this period. We don't know. penalty. No any UAE law has been drafted without penalty provisions. So penalty would be there if you are not complying, or you are misusing the provisions of the corporate law. Then government will definitely impose the hefty penalty. Transitional rules. Transitional rules means, there is one Article 61 in the corporate tax law. It specifically told about transitional rules. So transition from pre-corporate tax period to post-corporate tax period. So it is provided that you have to make one financial statement for your last pre-corporate tax period, and that financial statement would be considered as for carry forwarding the opening balances for the next year. So for say example, you have the calendar year January to December in your business. So corporate tax would be applicable for the first time in your case on January 2024. So your tax period would be 1st January 2024 to 31st December 2024. So here transitional rules would be applicable for year 2023, exactly the previous year of the corporate tax year. So in year 2023, you have to prepare the accounts properly, and you have to make your financial statements as on 31st December 2023, and whatever the closing balance would be there for the 31st December 2023 would be carry forward as opening balance as on 1st January 2024. Obviously, government has provided us the ample time frame for smooth preparation and implementation of the corporate tax, unlike some other countries in the GCC which have not provided this much time. So we have very much sufficient time to make the preparation. General Anti-Abuse Rules. This is called GAR. Corporate tax law has one article, and that article is asking about the provisions of General Anti-Abuse Rules. What does it mean? It means that if you are making any arrangement, or if you are making any changes, or if you are making any transaction in the year before the corporate tax is applicable to you, and that due to that arrangement, or due to that some changes, if corporate tax is going to be impacted, or corporate tax going to be reduced, or you are misusing the intention and the concept of the corporate tax law, then authority will catch you at any time, and that arrangement, or that changes would be considered as ab initio cancelled, and it would be impacted to your business. So whenever we are making the planning for the corporate tax, we have to keep these provisions of general anti-abuse rules in our mind, so that we can so we should not caught with any litigation or prosecution by the government for this clause. So that's all with this. I have only touch upon all these provisions very broadly, and we will come with some specific video for each and every point, so that we can give you the explanation how the corporate tax law would be implementing in the coming years. Thank you very much.